I guess there's accountants and planners who, have been big fans of resi property and self-managed super funds. I think that the numbers of people that actually should consider that strategy are actually quite low. I think you need a really big balance. You need to be massively contributing at least a full concession or comfortably every year. And you also still need to be able to be diversified. So you need not only a decent amount in resi, but you need to be able to have a decent amount in other assets. Otherwise, you're just basically punting your retirement on the resi property market.
This podcast is proudly brought to you by Pearler, the official brokerage platform of Rask. With Pearler, you can effortlessly automate your money, whether you're investing in ETFs or shares from Australia or the US stock market, whether you're a grandparent or setting up a kid's account or your own account. You can do all of that with full automation on pearler.com. If you want to learn more, head to pearler.com/Rask. And of course, before you invest in anything, be sure to read the legal documents like the PDS and FSG.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with the man himself, Chris Bates from the Alcove Group, mortgage specialist. Chris, how's your week been? Any more positive news this week, or volume still well down your end?
Oh, look, I think that the positive news is the legislation sort of put through. I think that's just, what they're going to do, what is going to get through, and I think we talked about it on Tuesday last week. I'd say we're one of the first ones to actually discuss it. Everyone feels like they got blindsided, and this was outrageous that they're banning self-managed super fund lending. But, the writing's been on the wall for a long time, I would say, around that. And it was a mistake, in my view, not including it just because of the behaviour we saw basically from budget night through to when they made that shift around, if you want to buy an investment property, self-managed super fund, and everyone was pushing it. And when all bank sort of turnaround times, even though there's no many banks in it, there's only really non-banks doing self-managed super fund lending, and their turnaround times went through the roof. And there's been uproar in the last week, and I think that's been, a good news because it's legislated. I mean, there's this sort of second tranche, though, that now it's getting peddled around. What are they, this widow's tax? There was, the government, everyone's gone at the government for that. And, I think it's going to be interesting to see what they do in the second tranche, which probably won't be touching, property in a lot of sense, or even potentially shares, but it might even make further carve-outs for sort of startups and small business, which I think it will.
Yeah, so that's actually one of our main two news stories we're going to cover this week, the ban on self-managed super funds. So we'll come around to that shortly. So I guess just a bit of a recap. Our old friend Scott Murdoch of Reuters did a nice overview piece of what's been happening in Australia. And I guess, if you're a regular listener, this would be familiar to you, but I'll just quote from Scott's article here. So a policy shift unveiled last month is the biggest in decades and is seen by some as ending Australia's obsession with property. For generations, the primary way to build wealth, making Sydney and Melbourne among the world's least affordable markets. And then he steps through the Labor government's plan to scrap the capital gains tax discount and also negative gearing, which allows the investment losses to be offset against taxable income, which will be banned on existing housing. So I guess I think Sydney and Melbourne markets were probably already coming into a bit of a slowdown or even a downturn because we've had higher mortgage rates in recent months, and that's sort of dampened enthusiasm after a really quite optimistic few years. But now a combination of all those factors, lots of articles over recent weeks about the worst auction results in years, possibly 5 years, maybe more, depending on which indicator you read. So, yeah, I think I've got a couple of stats for you here, Chris, just on SQM's asking prices index. So if you look at houses, Sydney over the past quarter, minus 3.6%, Melbourne minus 2%, Brisbane also minus 3.6%. Units relatively flat, really, over the quarter. But it's interesting, isn't it? Because we were chatting just before we came on air, how the indexes often seem to lag behind the reality. And I guess if you're going to an auction now versus a year ago, in a lot of cases, you might be paying maybe 10 or 15% less, depending on the market. Obviously, there's a lot of different parts and subsectors to the housing market. But obviously, the real ebullient environment that we saw a year ago has really gone away. And maybe those indexes don't really keep pace in real time with the reality of what's going on.
Yeah, I think there's lots of people banning around a two-speed property market. I mean, that's the first dial down from, say, a national property market, saying that the Adelaide, Perth and Brisbane are beating to their own drum, and Sydney, Melbourne much more tied to interest rates, sentiment, borrowing capacity changes. And I think that's been true. And I think that the Sydney Melbourne market were absolutely turning over just because the middle of last year, they had a bit of a run when interest rates got cut 3 times and confidence really peaked, when there is expectations that more to come in 2026. I'd say that's probably July, August last year. And then bang, some bad inflation numbers come through and then, rate cuts are going to rate increases. This is regardless of the budget. The budget's not really, the thing that's causing this sort of market rolling over. I think the libs are absolutely saying, oh, you're crashing the property market. Well, no, interest rates and borrowing capacity and Perth, Adelaide and Brisbane were already hitting affordability thresholds, right? I think you'd have to probably argue that as well, Pete, right? It's been a pretty big run. If you go back to 2019, we're talking well over 100% in these, and in the last sort of 5 years, probably close to sort of 80 to 100%. And so I think they've just had a really big run. And what seemed, really affordable, houses were 500-600 in those cities. Now they're sort of over $1 million. So they were just naturally hitting an affordability curve. And the budget has come in, but the effects of the budget, it's too early. It's really investment focus. It's not owner-occupier focus. And so the impacts on the investor market are going to come over the next six months to years ahead. It's whether current investors sell because they're worried that, basically the CGT from July next year, and have they got poor assets, and do they want to potentially put their wealth into upgrading their home or super or other assets with the tax changes, and do new investors enter? I mean, it's really hard on the established market. They'll go to completely different markets to what they were going to pre-budget. It's just that same model doesn't work often, and it's really hard for new investors. And so new investments are going to be way down. I think that's part of our story around self-managed super funds, which is just another way of sort of slowing that down. And, buying new, well, what the new developers need and builders need, they actually need prices going up, not down. And so if you're in this market and prices are going down, that's going to make it harder and harder feasibility to stack up. And building prices, there's just that extra sort of supply crunch, I think, with the sort of the oil crisis, affecting materials. I think it just knocked, confidence again for builders. Builder insolvency has been way up for the last 4 or 5 years. It's been tough, right? And, a lot of that sort of confidence in the market, I just don't think it's there. And I don't even think people are selling them at the other end as well. You sort of look and track new developments, they're just sitting online forever. The reality is, if it's sold, it'll get offline. There's no point advertising it or putting it on digital real estate, particularly if you're an agency. You don't want to waste, people's eyeballs pursuing things that they can't buy. So things are just sitting on there. And that means that they haven't got enough stronger buyer pools. And so, yeah, that would be my take, Pete, is that, the market was already rolling over because of interest rates. Now, that's the story that people will start talking about again. And we were talking about week on week is where our rate expectations are. But would also argue that we're probably heading more towards a recession than a sort of stronger growth market. And that consumer confidence, the negative wealth effect, as there's media today and RBA, AFR, is how big's too fall in property markets. That's going to dominate the cycle. And then I think it's, what's the medicine, I guess? What do they do to sort of support the market? That's going to be interesting to watch.
Yeah, I think you're right. Obviously, we don't get the full effect of the budget because it takes time for all this stuff to be legislated and then for it to have its full impact. But certainly on sentiment, you can see it's had a very marked effect and very quickly. On your point on potential recession, I saw Dave Taylor from ABC News. He tends to be a bit of a doom and gloomer. He does like a sort of a doom and gloom story sometimes. But he said Australia could well be already sinking into at least a per capita recession, if not a full recession. Just some stats out over the past week. I saw the jobs figures, the labour market survey, and I saw the headline number. Oh, wow, 40,000 increase in employment. Okay, it was part-time roles, but that sounds pretty good. But then I saw the previous month was actually revised down to minus 40,700. So actually over the past 3 months, employment has now gone nowhere. Job vacancies are gradually trending lower again. And if you look at that interest rate trajectory, well, the rate hike in August is now priced at less than a 20% likelihood. So I think that's one little factor that's giving some home buyers a bit of confidence, because when you've come off the back of 3 interest rate hikes, and the price of fuel suddenly went through the roof. And yeah, that was nerve-wracking, I think, for a lot of buyers. I mean, they always say the plural of anecdote is not data, but we're very much a boutique business, but we've signed up 7 or 8 clients over the past week. But that's coming off the back of a number of weeks where there was very, very little happening. A lot of people were just absorbing what was going on. But I would say, though, just to caveat that, there's no sort of investors in the established market really coming in. It's definitely more so, it's first home buyers, it's people upgrading, people looking to buy development sites potentially, or commercial property. There's just nothing coming through for investors in the established market. It seems that sector has just disappeared, and you can see that if you just look at the weekly auction numbers, the stamp duty take is maybe 2/3 below what it might be. So there's a big sort of hole in the market there, but some people are transacting. I've seen a couple of pieces about little moves here and there in fixed mortgage rates. But if somebody comes to you today, I mean, obviously it depends on the circumstance, but I guess for people who aren't that familiar with what's going on with mortgage rates, what kind of mortgage rate would be normal for a home buyer now? And same for an investor, what kind of rates would you be paying?
Margins got a little bit tighter. So I think a way to think about it is probably 1.8% above the RBA rate / 1.7. That's kind of like an easy number. I mean, I remember when that was well over 2% above the RBA rate, in fairness, like bank pricing and net interest margins. I mean, that's not technically how it works, but it's pretty close. Is around 1.7, 1.8. So if you add that onto the RBA rate, it's a good little sort of number in your head. If anyone's listening, if RBA cuts, then add 1.7, 1.8, and that's probably where a good rate is. So it's 4.35 plus 1.7. You're looking at low sixes, right? Like that's a good rate. Under 6, probably super sharp. If you're looking for investment and investment interest only, anyone sort of it's been around for a while. I'm turning 40 this year, Peter, which my mate's 40th on the weekend. I'm getting old. Remember always back into that last boom, right, when they had to slow down investment lending, the banks thought, hang on a sec, this is a good idea. We'll charge investors more and we'll charge interest only more because there's a cost of capital and blah, blah, blah. That blew out to over 1%. So a good home loan rate on P&I would say 6 in this current market, and an investor rate, we have 7. That's sharpened all the way back down. And we're talking maybe a 20, 30 basis points, maybe 40, depending on the lender and how competitive they are. I think ING's got a ridiculous rate at the moment. That's interesting as well. I think, that margin's just so tight for investors. And I think they're really going to struggle for investment loan book growth. They've got to say, well, what am I going to pivot? How am I going to keep on driving loan book growth? Because they're all competing with each other. So I wonder if we're going to have to offer a refinance wall, which they don't want to do because they cannibalized all their loan books a few years ago. And if you look at, if you type in loyalty tax, RBA, you'll see that it was, 50, 60 basis points. And now it's basically 0, which means basically existing customers are on the same rate as new customers across the whole mortgage book. There's very few that are overpaying. And actually a lot are actually getting a better rate than they can get in the marketplace just due to the competition a few years ago. So that's another interesting. What do the banks do to keep on driving lenders? There's banks that are just growing at a ridiculous rate because they've just got technology that beats everyone else, like i.e. someone like Macquarie. But then there's other banks that only way they're going to win customers from brokers. And 82% of loans went through brokers last quarter. That was a new record. That's a lot. Brokers will only go to certain lenders if they offer really good rates. And so do we see a rate refinance? Well, it's definitely not now, but you'll hear it here first when we do see it.
Well, it's a pretty interesting context there for your 6% mortgage rate as a kind of a rough benchmark. If you look at SQM researchers' figures, they run some pretty handy indexes on things like asking prices and weekly asking rents and so on. If you look at the rental yield nationally, of course, it's a big market, 11 million dwellings. Rental yield on houses in Australia, 3.8% nationally and 4.8% for units. Now, you can see straight away, if you're getting a yield of, let's say, even if you're getting 4% on a house, if the mortgage rate's 6, unless you're putting down a very large deposit, you're losing money. And therefore, you can see straight away why investors are not going into the established market. Those rental yields, one way or another, have to rise before investors come back in. Now, if you look at Sydney and Melbourne, you see the rental yields are starting to rise, partly because prices are coming down and also rents are going up. But I think we said even 3 or 4 weeks ago that one way or another, those rental yields have to rise quite substantially, and mortgage rates probably have to come down before investors would actually seriously consider coming back into the established market. And it looks to me like there's a fair way for that story to run before people might get serious again. So I imagine you'd be saying the same thing among your applicants for mortgages.
Yeah, absolutely. I think I was just chatting a good chat to my business partner, Ben, yesterday around this. And, what are we seeing? What's some pivots? We're absolutely seeing the home renos come back. Not huge ones. Not like I'm going to spend $2 million on a pretty luxury build. Like that stuff's not there because valuations and build, they just don't stack up, and it's just too much risk under higher interest rates. So, that's very heavily linked to sort of price growth, because you want to basically build into price growth, and you want to have a fixed price contract and not worry that you're going to have a valuation issue and et cetera. So I don't think those big builds are going to come back. I do think builders are going to be wanting to do fixed price contracts though, and they at some point. But the smaller builds, 100s, the 200s, the 300s, I'm not going to sort of, and there's value in that, particularly if you can do it, $100,000 and add $200,000 of cost to value, because it's all tax free and there's only limited ways to do that. And you might sell it now, you might sell it in 3 years' time. And so I think we're going to see a little mini building boom across our cities where, people have got a bit of excess capital. They were thinking about buying an investment property. Now they can use that and they spend it on their home. And, that's not great when you've got a competition of resources with, commercial, industrial, Olympics, blah, 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 government spending, et cetera. So I think you're going to see the builders and the subbies have a lot of demand there. But if you're not buying if you're not doing that and you're not buying an investment property and you've got equity, I think this is going to be the rise of share investing. I think this is where we've already seen, that dollar cost averaging, sort of releasing equity to buy shares, because you can still negative gear shares. I think that's not really well known. I think people have just got wrapped up in the property changes. You do need to be careful, though, what you buy. I think before you could probably be less concerned around capital gains tax and making sure that you just maybe go for an easy management option to invest. But I think if you do that now, you can really get burnt with picking a fund that, has a lot of CGT that's passed on to you, potentially buy a fund that rebalances and, has a lot of internal capital gains tax that you have to pay. So you've got to, this is where I think personalized sort of portfolios are going to matter now again. And I think this is going to also help the advice industry to sort of add more value around, not so much trying to outperform markets and picking stocks. I think, that's a pretty tough game. But, building portfolios that minimize tax impacts. And I think that's going to be a big rise of the, coming years, people releasing equity to enter into the stock market. Not always in Australia as well, going international. I think that's something that, we've always got a very home bias.
Yeah, good time for accountants and advisors. I guess actually you preempted a couple of our listener questions this week. One is about property and shares, and another one is about a negatively geared investment property and whether to keep hold of it. So stick around for that at the end. Let's run through our main 2 property news stories of the week. The first one we've already touched on, self-managed super fund ban for property borrowing. So prospectively, you won't be able to use LRBAs to buy residential property in your self-managed super fund. If a contract is already signed, then the purchase may go ahead. But I think, going forward, I think you could have a problem potentially finding lenders, because not many lenders are going to be in the space, and you could get trapped on a high mortgage rate. So there's all kind of risks like that to manage. I think it's sort of it was thought by Treasury that only about 1% of property purchases are in the self-managed super fund space. So I think there's a couple of sides to that. Well, yes, from that perspective, maybe not that large volumes. I think, though, there is a bit of a counter argument, and this has been covered variously by Nerida Conisbee, from Ray White on LinkedIn. Also, the Fin Review did a piece on it. I think sometimes when you're just thinking out the margin, I think a lot of developers, when they're selling new projects and they're looking to maybe make 70% pre-sales to get the project to feasibility, well, yeah, actually in quite a few cases, the super funds could be a significant chunk of that, and therefore maybe going forward that has an impact on housing supply. Now, maybe some of those buyers could buy in their own name instead, potentially, There was a bit of back and forth. I see Treasury said that they thought maybe around 4,000 or 4,300 purchases maybe under those kind of arrangements in 2024. I think some of the developers say, hang on, these figures are understated. But I guess you're sort of someone at the front line of lending. What's your take on that, Chris? Do you think it's a significant thing for the housing market, or is it just going to be a case of suck it up for the developers?
I want to tell you a story about how the new Rask platform came to be. In 2025, everyone was still waking up to this idea that AI was going to have an impact on the world. And it wasn't until mid to late 2025 that it really hit me like a ton of bricks. At that time, I thought, what can I do with this new tool, this innovative technology? That set in motion what has now become a totally new Rask platform, which you can find at rask.au. It is 100% free to create an account and start using tools. But what did it actually do, and what does it do for you? At Rask, we've produced thousands of podcasts, probably 20,000 articles we've written on investing and all of these different types of things like personal finance, superannuation, you name it. So we really needed a place where we could bring all of that together for the entire community. But once we built the platform, we realized that that wasn't enough. So in 2026, we've decided to launch a new community known as the Rask Ultra community. This is the deepest, most advanced part of what we do as a business and as a community of investors and builders. We want to build a network of people that can come together and share ideas in a new ecosystem that we've built just for you. You can find out more, like I said, by Googling Rask Ultra or by creating a free account at rask.au and see if Ultra is right for you.
Oh, I mean, there's definitely a lot of different stakeholders in it. I think there are some brokerages that have sort of niched in this. I think that was a dangerous niche regardless. I think there's some planners and accountants that would love to sort of have advised on this. I think a lot of planners, just being fairness, that they don't really know what to do around the property decision. This is my biggest concern, is that I think the more that I know, the less I know, and the less that I know that other people know in this space. I think that I really worry about those planners and who they're referring their clients to for their SMSF property, or if they just sitting out and they go, okay, you can set it up and it makes sense if you put on these forecasting at 7% a year and blah, blah, blah. But that doesn't mean every property grows at 7%. And so I'll be really, I guess there's accountants and planners who, have been big fans of resi property and self-managed super funds. I think that the numbers of people that actually should consider that strategy are actually quite low. I think you need a really big balance. You need to be massively contributing at least a full concession or comfortably every year. And you also still need to be able to be diversified. So you need, not only a decent amount in resi, but you need to be able to have a decent amount in other assets. Otherwise, you're just basically punting your retirement on the resi property market. And if you've already got all your wealth in the resi anyway, like you're just basically all in on residential, you've got no diversification. And so I've never really been a fan of it. And I became less of a fan of it when borrowing capacities dropped really tight. Unfortunately, on the last 2-3 years, the amount of money people can borrow through non-banks with, I would say pretty lackluster accounting letters to basically, I can borrow based on forecasted contributions. And you can basically, even though the client isn't guaranteed to do that, would struggle to probably to make those contributions, they can borrow the money. And so I think it had to get shut down personally. I think it's similar to the situation with trust lending, and that happened in 2025. We saw that there was a loophole in some sense where people could borrow a lot of money through, shopping bank to bank, and banks not asking for information about other trust loans, and all of a sudden you could leverage up much further than you could. That had to get shut down because there was constant marketing all over social media. If you type in unlimited borrowing capacity, if you type in self-managed super fund lending in the last month, you'll have no shortage of articles. And, it's a financial product. So this is, I think, the other thing is that when people recommend it, it's actually recommending, or encourage it. It's a really dangerous path. You need to be licensed to do so. And a lot of people weren't. So I think it needs to be shut down, because I also think that, one of the articles that I find it quite funny because it's on the AFR, which we'll put in the links, but it's basically saying the industry slams incorrect government estimate of 4,000 home loans for SMSF. And 8 companies who were anonymous, they weren't willing to put their name out there, are saying that they buy more than 4,000 a year, and they're just developments and new property. So, that just, they've kind of proved their own point. They basically said like that they're setting up more than 4,000, people are punting their retirement on new builds. I mean, it's not really what you want to be doing. If you're buying a new build, it's a lack of scarcity. It's, you can't get the, depreciation benefits aren't as big. You can't get negative, like, why do you want to pump your super fund on a new property? Is there an impact in the development industry of buyers, the lack of buyers? Yeah, well, then build a better quality product that suits owner-occupiers and know that you just can't take advantage of people's self-managed super funds. So, I don't know. I've just seen so many bad examples of this, Pete, over the last decade, and where people have lost a lot of their retirement because they have gone and basically spoke to the wrong people. And I think it's one of those situations where, yeah, it's okay for a few, but for the masses, I just don't think it's a strategy that many should be considering. And unfortunately, everyone was considering it, in some sense, post-budget, because it was the only way to buy another resi property. And people love to just love property and hate super and shares. It's just the Australian obsession of overconfidence to property.
Well, yeah, it's funny you mentioned about the spooky on Instagram and so on. I think, I guess in the short term, there'll be a lot of super funds scrambling to finish some half-completed deals. But I think it's always there's a sort of law of unintended consequences with this stuff. And I think you might have mentioned a couple of weeks ago, self-managed super funds will no longer be able to borrow for residential property. So you straight away know what's coming next on Instagram. It's going to be a sea of webinars on how to use your super fund to buy commercial property. It reminds me a bit of the old analogy when they blocked off Niagara Falls in the 1960s, and I guess the water's got to go somewhere, right? And then Horseshoe Falls gets overwhelmed, and there's all unintended consequences, and the flows are still going to find a way somewhere. So I think it's been quite amusing seeing some of the backflips going on the property spruiking space over the last month or so, because first of all, it was like, well, negative gearing, well, that doesn't matter, you can go here. And then super funds have been shut off. Oh, okay, well, that doesn't matter, we can go here. It's all a little bit desperate. I think you just need to be a bit wary about some of these hard pivots going on, shall we say, because no doubt there'll be a push on to new builds and new apartments, and then it'll be commercial space, and then the next thing and the next thing. But of course, you've got to remember, it's a bit like asking a barber if you need a haircut. There's always going to be people there prepared to help you out, in inverted commas. Let's have a quick look at this second news story before we go on to our listener Q&A. So first home buyers at risk of going backwards. So this was also covered by Narrative Conisbee, Ray White, also actually came up in Parliament this week. The opposition spokesman for business, Dan Tehan, asked Housing Minister Claire O'Neill about a slowdown. This is a quote from the Fin Review. In the country's two largest housing markets, he questioned, does the Housing Minister know how many first-home buyers owe more money than their house is worth, referring to O'Neill's comments about a housing market correction last week. So this was one of the criticisms of the government's 5% deposit scheme for first home buyers, is that if there's a housing market downturn, of course, if you keep making your repayments, that's fine, but you could find yourself in negative equity. And I dare say there would be some people now in that situation exactly. Nerida covered this in her piece on LinkedIn. Is there a risk of negative equity for first home buyers? Yes. Potentially. I think also, as she points out, yes, the 5% deposit scheme is there to help first home buyers. But if you withdraw all of those investors out of the market, well, actually, those markets are not going to be as strong as they were previously anyway. I think certainly up until quite recently, that the sort of the lowest priced properties in the market had been quite well supported by first home buyers and investors. But maybe that dynamic starts to reverse a bit now, and it'll be more of a sort of a flight to quality rather than just buying the cheapest thing on the market. So, what's your take on that, Chris? A bit of a risk of negative equity now as some of those markets turn down?
Yeah, I mean, you and I are both talking about this all the way through the last few years, is that, markets that have been driven by investors and owned by investors are at risk. I didn't think that obviously negative gearing was coming. I mean, shouldn't have been surprised, to be honest. I think we all should have realised they tried in 2016, they tried in 2019. They weren't brave enough in 2022, and they weren't brave enough to bring it to the election in 2025. But the reality is the long-term policy has always been their stance, and they just haven't had the political power to do it. And so now that it has happened, I think, it was already together with, the markets of investors. It was just a different type of investor. The last 5 years, it's just been a different style of investing versus the previous 5 and then the previous 5 before that. And, so I think that markets that were driven heavily by investors, a lot of investors and buyers agents from interstate pushing markets. If you're a first-time buyer that got wrapped up in that, peddling the market up, I think you're in a bit of trouble, because if those investors over the next 6 to 12 months, but those markets had very low listings. And so you might find that the support might be now, but it might be in 6, 12 months' time. You might find, hang on a sec, the markets can't revalue quite quickly, because you would have seen this before in the past, Pete, where there's a demand-supply imbalance. There's too much demand, not enough supply, prices go up. If the supply-demand imbalance goes, not only does supply keep increasing, days on market's increasing, then the demand really reduces. There's no urgency. They also can choose the best properties in the market. And so basically you're at the mercy, and some properties just never sell. They just can't sell. It can be really dire in that situation when, all of a sudden there's a lot more properties on the market and not enough buyers. And particularly if it's not just within one market, it's in like a glut, so an area. And then all of a sudden that SA3 sort of level, and there's a lot more listings and just not enough buyers. And people buy, but they put in lowball offers and they want the best properties on the best streets. And it can flip. And so I'd worry about people in those markets. I also worry about anyone in high density sort of, those investment properties in high density could be 60, 70, 80% of a building, if not more. And so, if those investors in them sort of take their money and run because they want to put it into super, or they in a Brisbane apartment and all of a sudden they bought it for 500 and it's worth 800 because of a real boom, then I think, some first home buyers will get caught up in that. And also in the Sydney market, I think a lot of first home buyers the last 2-3 years, it just, and not so much, because it's only been since October that they pushed it up to 1.5 million. So it was a lot of those sort of, sub 1 million, high density apartments. Unfortunately, first time buyers who, just didn't know, who to speak to, who to get advice from, and, wanted to get out of the rental market and just bought what they're renting. And I think that they didn't really know that those properties just weren't good assets. And so my worry is if, a lot of investors decide to bail out of those as well. And that's where you'll see that the first-time buyer could have a bit of negative equity because there's more sellers than buyers.
Yeah. So, I suppose on the plus side, the downturn has made it a better time to be searching for a property to buy. But obviously, if you're already in the market, you've got to work through this difficult period. The good news is unemployment's still low, and most people who want a job still have one. And most landlords have got tenants. So from that perspective, defaults are still pretty low. But we go through these cycles periodically, and we're in a downturn right now. So we've got time for maybe 2 listener questions. So the first one is from Mr. Toast. Should we sell a negatively geared investment property? We're a 28-year-old couple with an 11-month-old. Mum is now working only 2 days a week, so cash flow is tightened. We own our home plus 1 investment property, which is negatively geared, costs us about $1,400 a month before tax, owned 50-50. So we're making ends meet with a small buffer, but it's tighter than we'd like. I want to sell. The plan is to pay off our remaining HEX debt, boost our emergency fund from 3 to 6 months of expenses, and put the rest towards paying down our place of residence mortgage. However, my partner is against selling. She feels we'll be selling our future and worries that without this property, we won't invest enough and could fall behind long term. What's your take, and how should I discuss this with her and address her concern? So, I guess what you've described there is the kind of a pretty prudent approach. If cash flow's tight, you've got an investment property that's costing you a fair bit to hold. Now, there's loads of unknowns here. I don't know which market, don't know what the property's like, and so on. But I suppose if you were to go with that approach, it basically takes you from having a small buffer into a more comfortable situation. You can build up some equity, capital gains tax free in your own home. I think in terms of your partner's concerns, it's a legitimate concern that people potentially, if you've got more money, you just spend it, you don't invest it for the future. And I think certainly in the past, there's been this kind of view that property is the only way to go for a lot of people. But it doesn't mean you're going to fall behind long term. The world keeps turning. And I went through something not entirely dissimilar a couple of years ago. I had a property in New Farm in Brisbane. I didn't really want to sell it because I love New Farm, but My wife wanted to do a renovation on her own home. I was worried about the capital gains tax, but in the end, we sold it. The world keeps turning. It doesn't mean that just because you've sold a property, you're going to stop building wealth for the long term. You're going to pay down your mortgage, you're going to build your super, and maybe later on, when you've got a bigger earning capacity, you might come back even to an investment property. So I think the thing to do, though, and I'm sure advisors like Ramit Sethi would say, just run the numbers. I think that's the real thing, because that way you're making a much more informed choice and do it together. So yeah, my gut feel is, but just based on what you've described, is I'd probably lean towards selling, just because it sort of de-risks the whole process for you. But I guess, definitely do the maths on it and make a calm and informed decision. Because the other thing is, you don't want to pick up resentment. So I guess if you've got two different viewpoints, you want to come to an agreement together, rather than one of you saying one thing and the other one saying the other, because long term that can lead to more challenges. So what do you reckon, Chris? Any thoughts on that
one? This is one of the challenging questions, right? Is
it depends.
Well, there's so many other questions I want to ask you. Where are you living? Are you gonna have another kid? Did you grow up there? Do you think you're going to live there long term? The kid's going to go to school there. Where are they going to high school? Do you need to live near? Where do you work? What is your partner going to do when she goes back to work? So there's so many elements of other questions that you need to know those details to then get an answer of what to do, because everyone's living different lives. Everyone's got different, and the answer to that. So that's what I think you probably need to do, is go down a bit of a journey of a life planning chat and just start to get deeper and deeper around, well, where are you heading as a couple, family, and is your current PPOR the right property, the right place? Would it be better off to sell and then potentially upgrade? Is there potentially benefit to then sell cash and then do a reno? So that's that bit. And then the second bit is it really depends on what property you've got. It's really down to, what of those 11.5 million dwellings do you actually own? Is it an asset that is driven by investors? Is it an asset that a lot of investors own? Is it an asset that's done really well in recent years? And yes, it could still go up, but it's had a big run. Is it an asset that's really compromised? Is it something that's going to be easy to sell, or is it going to be hard to sell? So it's kind of like personal life chat, and then also the quality of your asset, and getting some really good advice around that. Now, if it sort of is compromised in any way, you've then got to say, well, how is that local market performing? Is there a lot on the market? How are they selling? Is it taking a long time? So it's also then, okay, we know what we want to do from a life point of view. We know we've got a good asset or it's a poor asset. We know we potentially want to sell it. Then how is that local market performing right now? Can I sell it easily right now? Or is it going to be really hard? What do I need to do to actually sell it? And then you got to try to sell it at the right time of year as well. You've got tenants in there. It's quite a process to actually figure out how do you actually sell that. And at the same time, the market's moving while you're sort of going through that process. And so, hopefully that helped answer your question.
Yes, and of course, as always, take specific financial advice if you're not sure. So time for one more question from Property or Shares. Very apt name you've given yourself there. So for listeners comparing property with shares in 2026, given long-term housing performance but the current headwinds, such as tax changes and interest rates, when does property still make sense over equities? Now, of course, this is a property podcast. I would say, property can certainly make sense over or even alongside equities in certain scenarios, but the bar is definitely now higher than it was for new investments in established residential property. So if you're looking at new build property, well, that's different for a number of reasons, as we've talked about many times on this podcast. The tax changes, which are not law yet, are presumably going to be implemented over time. And we've got mortgage rates at 6%, as Chris already mentioned. I guess, I think, the current environment is obviously much more difficult in established property than it was. I think if you already own investment property, those tax rules are grandfathered. But if it's going to make sense for you now, you really need to sort of be finding high growth locations with strong fundamentals, but also taking a long-term focus. And it may well be you could be buying today at prices that are 10 or 15% lower, who knows, than where they were. So that's obviously a benefit. But if you're looking at supply constrained areas, there's parts of the Sunshine Coast I know that always seem to fit into that category. You've got sort of a solid long-term expected total returns, and particularly if you've got a 10 plus year time horizon, then it can make sense, and particularly as a diversifier. I think historically housing markets in Australia have done sort of 8 to 10% per annum, and with the leverage, it's often been property that wins out in stronger markets. I think obviously if you're looking for equity, you're going to get potentially more liquidity, less cash flow stress, potentially more diversification more easily. So yeah, I would say that property is not dead. We seem to go through this, went through in the banking world commission where nobody wanted to go near it. The global financial crisis was, a lot of people were spooked out of the market, but this is the way the cycles go. It's always hard to be contrarian and be the person that buys when sentiment's at its lowest. But yeah, and as with the previous question, you've got to run personalized projections and numbers, ideally with an advisor if you need to, because markets evolve, tax changes happen, we have recessions and booms, high and low interest rates, high and low inflation. But property's always been a sort of a long-term game. And if you're looking at what's going to happen over the next 3 to 6 months, well, you're looking at the wrong thing, really. But Chris, what do you think?
I think structure matters a lot, particularly post-budget, So if you're comparing a home that grows tax-free versus shares, you're going to be paying X amount in CGT. Huge difference, particularly if you can leverage into a home. But when you're talking buying investment property versus buying, shares, well, hard now, right? You can sort of run a much bigger portfolio potentially with shares and run a negative cash flow that can be offset your tax versus a property that you're going to find it really hard often for people to just, basically cover that shortfall. That's under current interest rates and current rents. And we just don't know where they're going. Like if you want to gamble and say that rates are going to go to down 2-3%, then you might say, well, yeah, I'm happy to take that gamble. I know the shortfall cash flow is not there. I wonder if new property starts to make a comeback. I don't think it's going to be high density or house and land packages or cookie cutter townhouses that, are going to perform well. But, do we start to see there's this bit of a rise of the builder sort of, buy a house, knock it down and, put a duplex on it and then be able to hold 2 duplexes that, are quite well built, not like super luxury, but not, really cookie cutter. And so, that could be not a bad because you still own the land. You maybe doubled your rental income. You potentially can get negative gearing as well because you've increased the housing supply.
Big depreciation benefits as well.
Depreciation benefits and tax. So, I think we're going to see a bit of a rise of that, which I think is good because it densifies our middle suburbs. This is, basically people turning one dwelling that's maybe a bit old into 2 new dwellings that could be rented to sort of families. And so, yeah, there's going to be some shifts. Right now, though, and also with shares, I think people sometimes forget superannuation pretty much is shares. I'm very generalizing here, but most people, have got, balanced or growth funds. And in those funds, it's 70 to 100% in equities. And so basically you've got a share portfolio that is in a low tax environment. And so really, if you're thinking about buying shares, you've got to always be thinking on the other side of that and think, hang on a sec, I know there's restrictions around when you can access it and that sort of stuff. This is what you need advice for. But you've also got to remember that if you're only paying 15% on income and potentially only 10% on capital gains tax, that makes shares way better. And getting tax advantages of putting money in, you've got to remember that that's a pretty good bet. And years tick over. I remember I'm turning 40 before, Pete. And I think I just went to my mate's 40, so that's why I'm probably a bit more thinking about it. But, those years tick over pretty quick. And all of a sudden, you're getting in your 50s and you're like, oh, it doesn't seem that long away till I get to my 60s. And so don't forget superannuation. And those rules are you use it or lose it. And I think people are realizing it's a bit of a mistake if you do lose it. You can play this catch up and all that sort of stuff. I think people are going to be like, oh, maybe I should put more in my early 30s. I can't catch up on that far. I realized that was a mistake. So, yeah, that's another thing to think of.
Well, yeah, it's hard to get excited about your super when you're young. I remember when I was working even as a backpacker and they say, oh, you've got to contribute to your super. You're like, you what? But the years do sort of run away from you. And but as you get towards your 50s, you start thinking, well, hang on, but it's not actually too far to bridge until I'm 60. And then, it starts to come into the equation. So, yeah, that's definitely a thing that's going to be more popular as capital gains tax starts to impact more people. So, yeah, well, I've been enjoying the festival of sport that's the FIFA World Cup this week, Chris. Yeah, some big games starting to happen now as we go into the last 32. What about yourself? Any plans for the weekend?
Well, I had to check. While recording, Germany got kicked out, so that's pretty big news. I think France play them next as well, assuming they go through. So I think France, my best mate's French, so I'll be sending him a text soon saying you lucky bugger. Absolutely loving the World Cup. I am going to get up at 4 o'clock on Saturday morning. And some mates going to the local Ari to watch that game. But my favourite time of the couple times a decade, get to enjoy this much.
Yeah, it's good stuff. So if you've got any questions on mortgages, booking a call with Chris or his team. Likewise, if you've got any property buying questions, always happy to help out. And don't forget, send in your questions because we love to cover your listener questions in our Q&A each week. And thanks for tuning in. Don't forget to share the love and let your friends and family know about the podcast. So we're getting some really good numbers over recent weeks, which is great to see. And Chris, always great to get your insights. Look forward to chatting next week.
Look forward to it, Pete.
Cheers.
I regret to inform you that chances are a lot of you will need financial advice. Since we started the Rask Advice business, I've noticed quite a few trends, but one of them is the importance of having confidence in what you're actually saving towards or investing towards. A lot of people in the Rask community are very capable of managing their own money. But when it comes to critical points in their life, like retirement, selling a business, scaling a business, getting married, buying your first home, so on and so forth, getting expert advice will actually save you from a bunch of mistakes and give you the confidence to know what it is you're doing and why you're doing it. If you want to get matched with one of the trusted financial partners that we have, you can just head to rask.au/financial planning, or you can get in contact with us on any of the Rask websites. Not only does Rask itself provide financial advice, but we also have trusted partners if we're not the right fit for you. So we can help guide you in the right direction. And that in turn supports us to create more free financial education content like podcasts, courses, and so much more. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.